fantastic today.
Thank you.
Oh, sorry, I think that part was missed on the recording, Eric, but Rick, if you would like to repeat yourself. No, I'm just kidding.
Okay. All right. So welcome everybody to, I think we're on module 5 at this point, 4 or 5 through the integrated real estate investment training program that we've set up here. You've been through, I believe, property management, construction, underwriting. Thought there was one other. And what we're trying to do is take you kind of through the life cycle of a real estate investment. And while there are other modules to follow, one of the most critical elements is the financing process for a real estate investment. And it can get very technical. There are a multitude of types of financing you can get based on the type of building you're buying, based on the type of financing environment you're in. So what I tried to do here was water it down a little bit to kind of go with 2 examples for you all. One that would probably be a little closer to where you probably all will be in kind of your first investment, call it like the smaller building acquisition, similar to what Trisha did, where you buy a 2 to 4 flat, maybe you live in it, maybe it's like you're finding your first investment, and the financing on something like that is a little less arduous than a large building acquisition, such as the deals Drew and I have graduated to, where you start to use kind of more public markets debt. It is where we aspired to get, and we're kind of there, and it's where we hope many of you aspire to get after you try a couple small ones like we did. In order to speak about the broader capital markets version of financing, we brought along Chris Charboneau. He's with Walker Dunlop, a mortgage broker capital market solution firm that he has been extremely instrumental in helping us accomplish some pretty convoluted and creative financing structures. I'm gonna let Chris speak a little bit more about his background here in just a second. But he is, we not only does Chris work for us, we do very much consider him a partner. He's really helped us create a lot of value out of the investments we have. And one of the most important things to think about financing in a real estate investment is the people that are helping you obtain that financing are as much of a accretive element of the value you can achieve out of a real estate investment as is the person underwriting it, as is the actual person getting you the deal. Because without financing, you can't accomplish the returns that make real estate so attractive. So before we jump into the slides, Chris, I want to throw it over to you to introduce yourself.
Yeah, thanks, Eric, for the kind words. As Eric mentioned, I'm with Walker and Dunlop, which is, I want to say it's a top 5 or 10. We keep growing, so I don't know what it is right now, but we have offices in 29 states. We do about 50 billion of financing a year. I'm here in the Chicago office. We're a direct Fannie Mae, Freddie Mac, and HUD multifamily lender. Multifamily is defined by the FHA is anything over 5 units, so I do that. I also act as a broker for other types of debt, which would be debt from banks, CMBS loans, that stands for commercial mortgage-backed securities, and then life cos, which is life companies. So a lot of life companies have investment portfolios where they invest in commercial mortgages. So Walker Dunlop is a correspondent for. It's usually region by region. So I'm actually a correspondent for 45 different life companies. And then, I also have access to, various investment funds like, Blackstone, Starwood, company, big investment groups that I'm sure you've heard of also put out money. So, I work on loans from 1.5 million to, there really isn't a size limit. I think the biggest ones I've worked on are, probably a couple $100 million, but earlier this year, there was a gentleman in our Bethesda office that, closed $1 billion loan for a sizable multifamily owner based in Washington, D.C. So it sounds like for this module, it might be more pertinent to talk about, bank financing, which would be local and regional banks. And then, Fannie Mae, Freddie Mac, both have small balance programs, which, I can talk about those a bit and answer any questions you have. And, I'm assuming this will be an interactive type deal. And I can just tell you, answer questions and tell you what I look for in financing with the financing and with the properties that I'm financing. And I will say that I believe that what makes, if a property is a good investment, that also makes it a good property for a lender to finance. So we'll walk through how you get lenders comfortable and kind of sell them on the deal such that you get the best financing available to help you achieve your specific goals on that deal. So
cool. Thank you, Chris. Probably a lot of that vernacular was a little bit foreign to some of you before meeting Chris. It was to me, not tongue in cheek. Really learned a lot in working with him. We're gonna we'll keep it, as he said, a little more meat and potatoes on the type of deals he does. But it is going to be interactive. Please ask questions. I think I guess just take yourself off mute and ask questions as we go. It's okay to interrupt me or him. Don't hesitate. Just want to make sure you guys are getting as much out of this as you possibly can. So with that, we'll kick it off. So what is financing? There's a couple different terms that you'll hear. They're all kind of synonymous, but debt, loans, financing. It's basically just borrowing money to make an investment, right? What you'll also hear in the real estate investment world is we oftentimes say it's using other people's money. And that really means we're able to use funds that aren't ours and make a much larger investment than one would be able to do solely with their own money, as it's written here. So I wanted to pull a quick example. The way my brain works on thinking about a real estate investment is I try to just come up with an apples to apples scenario, right? And if you as an individual have $10,000, you buy 10 shares of stock for $1,000, and that entire investment appreciates by 10%. You've made your $10,000 into $11,000. Great, fine. You don't have as much control over the stock as you would, say, a property that you invest in, that you own, that you can touch, see every single day. But the more attractive part of investing in property is with that same $10,000, which would equate to your down payment if you were saying buying a $100,000 building and you would only need $10,000 of equity. And these are hypothetical numbers. I just want to be able to illustrate what financing really helps you accomplish. That building goes from $100,000 to $110,000. You've made $10,000 profit on the same $10,000 investment. And so this isn't rocket science. This is what has drawn people to real estate investing from the beginning of time when financing has been available. I'll stop questions. Speak up. If not, I'll hop on to the next thing. Okay, so as I started in the presentation, I said there's kind of two paths we're going to look at here. You've got mortgage brokers that are really what you typically find in the residential market for condos and single family homes. But those mortgage brokers also typically finance 2 to 4 flat buildings. And Trish, I want to come back to you in a second because you just went through this. Those mortgage brokers we deal with less now because we're not, really operating in the 2 to 4 unit space. On the commercial investment side, which is where we interact with Chris, this is where you obtain financing from a variety of different financing sources. And here are a couple of the terms that you heard Chris drop when he was speaking about his background and what he offers. So Freddie Mac and Fannie Mae, these are governmental institutions that buy and sell loans made by banks and other institutions to maintain liquidity in the capital markets. This is a government program that's been around forever. It is, from a macroeconomic perspective, the way the government intervenes in the financing market to make sure there is liquidity. And the way they do that is they offer basically a repository for people to come and swap out their loan products. It's like they're the bank to the banks. If you ever need money, you can flow it through these programs through the large governmental institutions, Freddie Mac and Fannie Mae. And then you've got regional national banks. So I call a regional bank or even a local bank Wintrust. A national bank is probably something more like a Chase or a Wells Fargo. Life insurance companies, this is a little more nuanced. Life insurance companies sell life insurance policies and they generate a bunch of premiums. And in order to meet the requirements of the policies that they're selling and premiums they're taking in, they have to invest that money. And they invest it in a variety of asset classes, but one of the largest is real estate. And individuals like Chris develop relationships with the life insurance companies who are looking to make or generate a return on the premiums. And he's able to connect us as the investor, the real estate investor, with the life insurance company that's looking to put money on the street. Bridge lenders, this is also more of a nuanced term, something that is even a more aggressive form of financing, where a lender will acknowledge that you're buying a building that's maybe dilapidated or it's had bad operators, rents are significantly below market, vacancy is up, occupancy is down, and they'll provide what is commonly referred to as a bridge loan. And that's exactly as it sounds. It bridges you from the acquisition through the value add process and into stabilization. There's slightly higher fees, slightly higher interest rates, but they're usually very, very nimble. They're very aggressive. They can get you pretty significant financing, amounts of financing, higher than maybe you'd find in a regional and national bank. And then kind of at the bottom of the list, I don't want to call them the predatory lenders, but the individuals that will lend you money at the most expensive rates and some of the most, I would call, prohibitive terms are the hard money lenders. A term you'll hear thrown around for come in really, really quick and give you money to close on a deal. So if you're, say, a real estate syndicator, someone like 33 Capital Partners, where we go out and talk to our friends and family and try to raise money, and it's taken us a lot of time to raise the money, and our closing on our building is coming up really quick on us. We need someone that will write us a check really fast, let us hold it for 90 to 180 days. We pay them a pretty big fee, but it guarantees that we get the property and we close on it. Drew and I have never used hard money lenders in our career. We hope to never have to, but it's always an option that we have available to us if we needed to move really quick on an acquisition. And one of the things those hard money lenders become very beneficial for operators or developers like ourselves is we need to compete sometimes against the big bidders who have a ton of money. And the only way we can do that sometimes is by offering very attractive terms to a seller, a short amount of diligence time, and ability to close on the building very, very quickly. I want to take it real quick to the Own It Fund, the Pleasant building that many of you have invested in. That was acquired and financed through a local bank. I think it was Hinsdale Bank and Trust, who was ultimately acquired by Wintrust. And we went to our relationship banker at Hinsdale, said we're buying a 6 flat. We think it's worth X. We're going to need to put, this much money in renovation dollars. And when we're done, we think it's going to be worth Y. Will you lend us 75 to 80% of what we say it's going to be worth, that, variable Y that I just said? What is the value of this building when it's completed? And we have a very, we have a close relationship with the lender. He goes out, he views the property, he makes sure he feels good about our operational capabilities. He wants to know about our plan. And then he or she will ultimately make the loan. That was the most simple version of borrowing that you can really accomplish in the multifamily arena versus, buying your own 2 to 4 flat. At the end of the day, we didn't have to use a broker on that arrangement because we knew the bank directly. If we were using a mortgage broker like Chris, and Chris, I apologize, I don't mean to water down your title. Chris is when I think of Chris, he operates in the capital markets. He provides capital market solutions. But for, just keeping the vernacular simple, Chris is a broker. His job is to go out to anyone and everyone he can get a hold of to say, I like these folks at 33. They know what they're doing. I like this deal. I know the market really well. I think you should provide terms for them to borrow on. And he'll do that with a number of different groups, and then he'll accumulate all those offers. He'll sift through them. He'll look through a number of different qualitative and quantitative factors. Doesn't just the interest rate and the amount of money they're going to give you isn't the only thing that matters. There's restrictive covenants. There's things that Chris is making sure that we're not pigeonholing ourselves with that would make this financing maybe not the most valuable to us in the long run. But at the end of the day, his job is to get us the best possible terms on the market. Stopping there real quick. Any questions? All right. So when you're looking at financing, and I want you guys really to just, the purpose of these trainings, for some of you, it may be kind of below your knowledge level. You already know this stuff, but it really is important to understand the elements that go into a financing package. So everyone knows what an interest rate is, obviously. Loan to cost or loan to value. This is a very important topic, and it's very important to be able to distinguish. You can buy a building for $1 million and put $500,000 into it, and that's $1.5 million. And the lender will lend you 75% of your total cost. That is your loan to cost. But some lenders may say, oh, hey, you're buying it for $1 million, you're putting $500,000 into it, and it's going to be worth $2 million. We're going to loan to you on the value, or the loan to value. So we'll offer you 75% of $2 million, and that's $1.5 million. So that is a topic that typically comes up when you are in a position to refinance a property, and we can come back to that later in the presentation. The amortization period, it's the number of months or years that you're granted to pay off your loan, but it's also used to calculate your interest. So if we're going to run a, say a 30-year amortization schedule, that gives you more years over which to pay your mortgage back, which reduces the amount of your payment. And that amortization period is really important to us because in the initial stage of a multifamily investment, typically you have lower cash flow. So you want to minimize the amount of outflows. And one way to do that is to be able to pay your loan over a longer amortization period. Transaction fees. These are basically almost the equivalent, not the equivalent, they are brokerage fees. They are fees that you're paying to either your broker or to the bank directly to make you that loan. It's how those individuals get paid for providing the financing. Prepayment penalties is a huge issue as you know, where we're, is we need to have buildings and apartment buildings, you can't have restrictive large prepayment penalties. Otherwise, that flip doesn't look as attractive to our investors because we're eating up a lot of the fees with prepayment penalties. Personal and limited guarantees. This is huge. Probably should have been number one. This is something that is critical for you to understand and assess in the context of ultimately your net worth. If you were putting a personal guarantee on an acquisition of a parcel of real estate with your financing source, that means that if things were to ever go bad and you couldn't pay back your loan, part of it or all of it, they can come after your personal funds. They can basically come after everything that you have personally available to them to make them whole for the financing underpayment, excuse me, for the underpayment you made in repaying your debt. Chris has beautiful, attractive programs to real estate investors that allow us to get out of those personal guarantees and enter into non-recourse loans. And every real estate developer and investor will tell you the same thing. Their end game is to get out of their personal guarantees as quickly as possible. That said, we don't have the luxury of not taking on personal guarantees when we acquire buildings. Back to the Own It Fund and Pleasant as an example. We guaranteed $1 million loan for a, call it 1 year duration, because we needed those funds to stabilize the building and perform the rehab plan. The bank said, we'll give you that money, but you're going to guarantee us that if things go bad, you're going to repay that debt. I said, okay, no problem. We accomplished the renovation plan. We accomplished the lease up. Kudos to the team that did it. We killed it. We beat projections. We find ourselves just about done with the refinancing of that building. And typically, Drew and I will go into non-recourse financing vehicles. In this case, because we're all in that one together, it's a company investment vehicle. We're staying with a recourse loan with another local bank. And they're going to refi out a significant portion of all of our collective equity. But we actually did something there that we typically wouldn't do. We went from a recourse loan or a loan with guarantees into another loan with guarantees. And it's something, this is pot kettle, right? But it's something I want to encourage all of you to understand and be very careful of. If you have the opportunity to get out of a personal guarantee, you do it at all costs. It may even be worth paying a little more on the loan or a slightly higher interest rate to get into that non-recourse debt. Because if the world ever turns upside down, the worst thing in the world would be if they're coming after your personal capital. Reserves and escrows, those are terms that you'll hear pretty much in every loan, but it's just really holdbacks for the lender. It's assurances, monies that are like a deposit account that are used to pay future needs associated with the property or the financing. Questions? Nope. What do I need to get financing? So this is where you all need to really start thinking about, your objectives and ultimately, if you want to be buying a building or buildings, it's important that you build your credit profile today. And that means, and this is, I probably sound like a lot of yours mother, but keep your credit score high. Okay, make sure you're constantly monitoring that. It's the first thing any lender is going to look at. Building a balance sheet or demonstrating liquidity. If you have the ability to retain cash, you're building your bank account, that's critical. Any lender is going to look at that to make sure, hey, has this person, not only does this person have money, but has this person been disciplined over their time of being gainfully employed from the day they graduate college or over a previous investment? Have they generated cash flow sufficient to have some minimum amount of liquidity? Experience in real estate. Go ahead.
Out of curiosity, how does student loan debt fit into that ability to finance?
Awesome question. Chris, you want to take that one?
Yeah, so some of that's going to be baked into your credit score, right? Because that looks at your income and then all of your monthly obligations, right? So none of the credit bureaus publish their algorithms, but there's a rough understanding of what they are, and it's basically income to debt. So to the extent you do have some student loan debt and you have to pay that every month, it will impact your credit score a bit. I would say banks also look at, they'll make you generally fill out a form and you'll have to show them like what your monthly or annual income is and then your monthly and annual expenses. So on that would be, if you own a home, it'd be your mortgage. If you rent, it would be your annual rent payments, car payments, and alimony, all that type of stuff is on there. So, the banks do their own credit analysis based upon your income and expense ratios. And then they'll look at the credit score to kind of, confirm what they're thinking. It's basically, the credit score is something that your banker will point to when he's presenting your loan to his credit committee and say, here's what was presented, and this confirms it, and basically that 700 number that Eric referenced is an important one. It gets harder. It's not impossible to do it below that, but it basically shows the bank that when you take on a debt, you pay it, and that's at the end of the day, that's what lender is most concerned about. Is they're giving you money, they just want to make sure that you're going to pay it monthly, and then pay the principal balance due at the end as well. So, and
Christina, to your question, it wouldn't be looked upon badly. There so such a significant portion of the population as student loan debt, they wouldn't look at that and go, oh, Christina's really not the type of borrower we want.
Right. Sorry, my long-winded answer. I didn't answer that very specific question. I would also point out too that low credit scores in and of themselves aren't a disqualifier. It just might be something they would ask you about and you'd explain, right? So if you did have student loan debt, you could say, hey, I believe this is dragging down my score a little bit, but here's the balance, and here's my payment history, and I pay all my other debts as well. So.
All right, good question. She's going to keep coming with them. She always does. I like it. So where I was at in experience in real estate investing, I'm looking this way because I've got the slides on this side so I can see everybody on the screen. Lenders are people, right? There's not like a box they're checking based on what they see on your credit profile and what your job says. They're looking at you as what they call a risk, right? Lenders are risk assessors. They are looking to place their money the most effective way possible, which is minimizing the likelihood that you won't be able to repay them what they lent to you. One of the ways to demonstrate or build that confidence with them is to show them that you've got experience in real estate, right? Just by virtue of the fact that you work in leasing or property management or brokerage, construction, right out of the gate, you've typically got a feather in your cap that maybe the layperson or you're a comparative borrower with the same credit profile and the same financial position, you've got a slight feather in your cap because you can demonstrate to them, I'm in this industry and I know what I'm doing. And that means something to lenders. It's a little more of a check the box thing when you're getting a typical mortgage from a typical mortgage broker. That is a little more kind of just check the box. But as soon as you navigate into that world of relationship banking, where a lender at Hinsdale or Park Ridge or in the city of Chicago and Avondale by where you live makes a loan to you, and you're talking to that human being, they're looking at you like, is this person capable of doing what they're saying they can do? One of the ways beyond just talking about your background and demonstrating you're a good person is being able to produce reliable pro formas, right? If you're purchasing an investment property, you are projecting what that property is going to do when you take certain actions to what we typically call stabilize it. You are projecting what the rents are going to be. You can approximate in a reasonable manner what the operating expenses are going to be. You can build a reliable construction budget. You are realistic in understanding what it will cost to actually renovate a project. You have a contingency, right? You know that whatever your construction budget is going to be, it's always going to go up by a little bit, unless you work with Cube, because we never go over budget, as everybody knows. You've got to be able to assemble that information and be confident about it, right? We have pro forma models here. Pro forma is a word you heard back, I think, when I was in the underwriting module. Pro forma is key. You got to be able to build one, and you've got to be able to speak to it. And if a lender, just if the lender is listening to you, talk about your assumptions competently and talk about your capabilities based on your experience in the real estate market, you got a leg up. And that's a lot of what these training modules are about, is helping you guys build that base, build that core of what it means to be a real estate investor, so that you can have these conversations confidently with prospective lenders, as well as other stakeholders. In future modules, we're going to get into raising money, raising equity, and being able to speak to investors with the same level of and competency that you lender and anyone else involved in the transaction. Question? All right. Did I skip a slide? I gotta speed up here. All right. So how does the process work? We're going to focus on commercial financing. That's why we have Chris here to join us. So stick with that. Yes, mortgage brokers typically utilize on the purchase of condos, single-family homes, and the 4-unit buildings, but we're going to stay with really the commercial side of it, just because I feel that's a little more interesting, and I think it'll help you guys get to that next stage of what it means really to be a real estate investor. So when you start a financing process, Chris will hate to hear this, but always approach more than one person. Don't lead your broker down a path of competing against another broker. That's disingenuous. You should have a relationship with, you can have multiple relationships with brokers, but don't engage multiple brokers on the same transaction. Pick your guy or girl and go with them and give them the opportunity to deliver. But at the same time, if you have direct relationships with banks, local banks, you should be reaching out to them as well, because you've always got to be your own advocate. And I'm not saying that your broker isn't being your best advocate, but that broker doesn't have relationships or the ability to get financing proposals from some of the direct relationships that you may have. Walk into Avondale Bank. That's not where Chris operates. But you may go into Avondale Bank and Trust and you're buying a 20-unit building and you need a $3 million loan. They may want to do that loan and they may have very attractive terms. Chris would do that loan and he'd get it from more institutional financing sources, but you've got to be your own advocate, right? And you've got to make sure that if you have a relationship or that you've built a relationship, you can leverage it. The most important thing when you're talking to anyone, and I know this sounds silly, Alana and I, when we're building the website right now, we're rebuilding the website, and we're talking about the message that we want out there. And one of the things we always come back to is values and integrity and honesty and truth. It's like, it's the same, it's kind of the same cliche terms that you see on everyone's website, and we mean it, right? That's what we're about, but it's out there for, like, everybody says that's what they do. Live that in your day-to-day, right? Be transparent and trustworthy. It isn't a watered down term, and it exists on all those websites because it's real, but you have to live it. And when you're speaking to people, it goes back to what I just said about picking one broker. You got to be honest with the brokers. You got to be honest with the lenders, and not just honest about your numbers and who you are as a person. It's don't lead these people down paths where they're working really hard for you, only for you to go and send it off to someone else. We're in the service-based business, and it happens to us so much, and it's the most aggravating thing when someone spends and wastes so much of your time only to just go cut you down and go to the next guy. So you're going to do what you want. I would just say, from sitting in the seat that I've been sitting in, and I'm sure Chris can articulate similar thoughts, be transparent you're working with.
Yeah, I mean, I think it makes sense. Don't be penny-wise and pound foolish. Most people are reasonable. I know Eric has his own sources and he talks with other people. And, to be honest, when I do my job, I pride myself on doing a good job, and I want to know that, I'm doing the best job for somebody. And if I'm not performing, I expect to be replaced. I think, most people are in the same boat, but, when someone, and I've had people do this to me where they spin my wheels and, I do a ton of work that I'm not compensated for, and they take my quote and they take it to someone else and they say, match this, and it's yours, right? And it's my work got that guy, a better loan. And, that leaves a bad taste in my mouth. And basically when someone does that, I usually give people the benefit of the doubt up front, but if someone does that once, I don't, I ignore their calls. And if someone asks, I tell the truth, and I can ruin your reputation. So I think, being open, forthright, and honest, and just, the golden and silver rules, treat others as you'd want to be treated, and don't do to others what you wouldn't want done to yourself. If you just live by those, they're pretty simple, and, it'll serve you well long term. The hardest time to find a friend or a lender is when you absolutely need one. So that's when your relationships, which, really become important, right? So, yeah, no one's going to give you the time of day if you haven't been respectful of their time and efforts historically. So, very true, Eric.
Is that a hand raise?
Yes.
Oh, got it. Much easier. All right, go. Yes, Miss Lynn.
So my question is, what are some of the advantages of going with a broker versus going to a direct lender? Because in my not knowing the system, but knowing logic, a broker needs to be paid some way or another.
Sure.
So am I in turn paying more to have a broker than I would going direct to a lender?
So that's a really good question. So, you know, a lot of the times I'm working with Eric, I'm actually taking out his bank financing, right? So I also have, I do brokered business to banks, but that's usually when someone calls me and they say, hey, my relationship lenders, you know, this deal's tricky and I really need some help here. And in those instances, they're paying me and their bank, but a lot of times they are okay doing that because the relationships they have weren't delivering a product that made the deal work, right? And really the right way to think about paying a broker, I think, is that it's a success fee, right? If they don't deliver a loan that works, you're not work. They get paid when the loan funds. So I think that's the right way to look at it. Like, go and see if you can do it yourself. But if you can't, you know, go and see what their options are. You know, I've been doing this for 20 years, so usually I can get a pretty good idea of who the best lenders would be and what the structure is going to be, just, you know, based on a 15 or 20 minute phone conversation. And, you know, Eric calls me sometimes, he's like, hey, what do you think about this? And, you know, there's been times when I'm like, here's how I'm thinking about it. Here's how we need to present it. And this is what it's going to look like. And a lot of times that is what it looks like. And I have generally, you know, a list of, you know, 3 to 5 of most likely lenders in my head. And a lot of times I'll take it out to, you know, 15, 20 or 30. And at the end of the day, it is those 3 or 5 lenders that are kind of at the leader of the pack once everything settles. With regard to why would you use a broker? So some of the loans that I do, like a life co, I'm sorry, I say life co, it's a life company loan. So as Eric mentioned,
insurance company.
They make investments in commercial mortgages. They basically make commercial mortgages for asset liability matching, but you guys don't have the ability to go to them. I am a contractual correspondent. My company services the loan. I underwrite it. So in that instance, if you wanted life company debt, if you're not going through me, you're going through someone else just like me, because you can't call them directly. And then, you know, for Fannie Mae and Freddie Mac, I am a direct Fannie Mae and Freddie Mac lender. So depending on the Freddie Mac, Fannie Mae multifamily lender, not 4 units or lower. But so in that instance, if you're not coming to me, you're going to another direct Fannie Mae or Freddie Mac lender. So it doesn't cost more in those instances because, you know, for Fannie Mae and Freddie Mac, there's minimums they set forth that any lender has to charge, and that's usually where Eric squeezes me down to. For the life company loans, those are par loans, which means the lender doesn't charge a fee, but I earn a fee, right? So that it's effectively the relationship between the life co and the correspondent, where the life company says, hey, we will make these loans to you at par, but you do all of this work finding loans and underwriting the loans and servicing the loans. So like on a life company loan, you know, I'm ordering the appraisal, the property condition report, the phase 1, doing the full underwriting and really presenting it to the life company's credit committee. So it all in, life company rates are usually pretty low, but you know, with I generally like to get a point. Sometimes I get squeezed on that. So that's 1% of the loan amount, but all in, if you can go to some of those sources, it's a better overall deal than if you stayed with your local bank, because most of my sources are also non-recourse.
I'll give you a great example. Everyone's heard us talking about the Windy City deal we're working on, and Chris does charge a point. And we had our local lender relationships really trying to get that deal to provide the financing of $30 million or whatever it was going to be for 2 of the buildings. And Chris was charging his fee. Chris was able to get us much larger leverage, loan to cost, the term I used earlier. He was able to get us 81% of the acquisition and rehab costs. That is 6% higher than anyone else could get us, any direct lender. That allowed us to raise almost $2 million less than we would have had to raise for the investment. That point, as egregious as it is, and despite how much I dislike Chris, that was worth paying every single penny, because that's a term that you couldn't necessarily get from your local lender. So terms matter. To the point that Chris was kind of driving to, it's right here on the slide. I love his line. The worst time to want a lender is when you need a lender, right? Because you're at their mercy. Get out there, make the relationships at the local lenders now. If any of you are serious about getting into the real estate investment game, take coffees, take lunches, get in with the guy or girl who's starting their business as a commercial loan officer at your local bank. Start there, or get with a mortgage broker at guaranteed rate, or maybe one of the young guys and girls that Chris has working for him. Take them out to coffee, pick their brain, establish a relationship. You will at some point, something will come out of those relationships, and it will be integral to your real estate investment career.
Okay. Eric, I want to interject. Growing up, my dad always told me you can never have too many friends, and I kind of just thought he was a tool and saying something. But the older I get, it's actually really true. So, I have people call me all the time for deals that aren't fit, but I talk to them, and I say, hey, this isn't a fit because of X, Y, and Z, and I always try to recommend. I can't do that, but here are 3 people that I know that can, and they're good people, and reach out to them. And once you do have something that fits, reach out to me, and we'll see if we can figure it out. So I do think just going out and treating people respectfully and being honest and sociable pays long-term benefits, right? Because if you're out there and you just even impress someone, even if you don't get anything done with them, they remember your name. You never know what can come of it. So
Chris and I met in the West Loop at that pizza joint Parlor,
yeah.
And then we've done $50 million in deals since, and all we did was have a drink.
And to be honest, like Eric, sometimes I get calls, and Eric won't even tell me he recommended someone. He'll just be like, yeah, I heard your name from Eric. And you can't have too many friends. So it's always good to have people talking positively about you and thinking positively about you. So,
and this business, real estate, especially on the transaction side, it's a very fickle business. A lot of personalities, a lot of drama. I always say this: huge money in real estate can be made so fast. And there's a lot of people that think they're super important when they make fast money. They think they've got it all figured out. But I think one of the major things we as an organization pride ourselves on is when you hear about 33 and cubed in the industry, I think you will generally hear in return, they're just good people. They're not going to screw you. They're salt of the earth. They're good people. And I think you maintain that reputation by doing all the things we talked about in this slide. You're ahead of 75% of the game in the industry. And we pride ourselves on that. So keep that in the back of your mind, like your mother telling you to be a good person.
Eric?
Yes.
I don't know if we're intended to see the slide right now, but we see the grid of the people and not the slide right now.
All right.
Cool.
How does the process work? I'm going to kind of spin through this because we're running out of time. So you've picked your lender, and the first thing they'll do after they say thanks, appreciate you going with us, send me all this information, your personal tax returns, if you have any LLCs. There's typically called a global real estate schedule. It's really just all of your properties that you own. Any mortgage statements from said properties you own, a personal financial statement, which is just your balance sheet, or this is everything I own and this is everything I owe. And when you subtract what I owe from what I own, this is what I'm worth. With that, probably your retirement account statements, and then just a general resume about who you are and how you've gotten to where you're at in your career. And that's usually just thrown over email. They will, I kind of put these out of chronological order, but they'll send you a term sheet actually first before they request that information. You want to look at those terms from the lender. You're going to compare them to the terms the mortgage broker provided you, and you're going to ultimately select your lender. And I apologize, I did put these in the wrong chronological order. After you do the last 3 bullet points, then you go back to the first bullet point to provide all your information. Questions? Okay, so you've selected your financing source. Your application has been signed. The next thing that happens is you have to do what we call third-party reports. That's the generic term for appraisals, surveys, inspections, environmental, title searches, etc. Basically, it's your lender doing their diligence, making sure that the property isn't encumbered, make sure that there's no environmental issues like big, unused gas tanks below the ground, or maybe you were next to a dry cleaning facility and it leaked, chemicals onto your property. Making sure that the property values where you're saying it's going to value. You are going to be part of and pushing that process to get the lender everything they need so that lender can provide the financing in the timeline you've set out. They will pull all that information together. They will really kind of, a lot of it hinges on the appraisal. They'll look at what the value comes back at versus what you were saying the value comes back at. They'll make sure that there aren't any issues. There's no fence that's coming onto your property that needs to get moved, or there's not some parcel of the land that you're looking to buy that's actually owned by someone else. They'll make sure that there are no liens on the property. I'm going to go to this real quick because it's a great example. A couple people on this presentation or on this call have actually just dealt with this with me. We have a building that they owe us $20,000 for receiver fees. We filed a lien and made sure that lien was recorded so that they cannot sell that building without paying us off. Liens show up in a title search, and it's important you get clear title because God forbid you buy a building and someone like 33 comes back and says, you owe us 20 grand. Like, I don't owe you 20 grand. And say, well, the prior owner did and they didn't satisfy it, so now it's on you. So you get a title search performed, and then you get what's called title insurance. Its title company says, we searched all the records on this property and everything's good to go. There are no outstanding liens or any other type of encumbrances. And if one pops up, you can come back and say, hey, title company, you told me it was clean. I purchased insurance from you guaranteeing that it was clean. You have to pay 33 for the money they say that I owe them. The financing source will take all that information, put it together and say, yes, we are good to go. We have obtained everything we need. We are, the value of the property per the appraisal is satisfactory. There are no encumbrances. We are prepared to make you a loan. We will issue you a clear to close. Once you are issued that clear to close, you know the financing is in place and you are ready to close on the deal. That is a acquisition financing process. Questions there before I jump on to refi? Should look at the hand raising. No hands raised. All right, refinancing. This is what every real estate investor lives for. It's the way you obtain bank financing, ideally in a non-recourse fashion, so you don't have any more guarantees, to pay off as much of the equity as you have invested in the property. Said differently, you're trading in your old loan for a new one. This is where commercial lenders, commercial brokers like Chris are integral. Trisha, you asked the question, am I paying more? Is it worth using the broker if I can get something cheaper? Well, go through a process with a commercial broker. And I've been through a bunch of them with a bunch of different brokers. And what I found, and I've learned this in the process with Chris, the commercial broker that you're working with is a salesperson working for you. And they are selling the lenders on why they need to make the loan that you're seeking, why they need to make that loan. One of the most critical things a great broker can do is convince that lender to lend you more money than you currently owe on your existing debt. When they can do that for you, you get additional non-recourse proceeds, you pay off your investors in full, and you can actually put tax-free dollars into your pocket. The building in Elkhart, Indiana, Chris was the financing source for that. He did that for us. We paid every one of our investors back every penny they put in the deal in under 2 years. And then we took out excess proceeds. We were able to distribute proportionate shares of those excess proceeds to all of the limited partner investors Drew and I and our GP partners were actually able to start collecting on our GP share, general partnership shares in the investment. And that couldn't have been accomplished without having Chris going out to the market and finding extremely unique financing for that deal. So refinancing is critical. The Pleasant loan that we are in the middle of refinancing, and kudos to Ryan Annisberger. Some of you know him. He's our partner on the deal. In fact, Ryan is how Chris and I got introduced. Ryan brought in a close friend who is a commercial lender at a local bank. They are making us a loan at a value for the property that will pay off the overwhelming majority of the equity all of you have invested in the deal. We did that by way of an appraisal that came in at a very attractive number. That really, at the end of the day, is going to turn Pleasant into a really great investment. The beauty of it is that you can ultimately, if you want to take just the big picture view, you can do what's called recycling your capital, right? You go in, you acquire this property, you do all the things to stabilize it, and then you bring in this new financing source. They give you back all of your equity. And what do? Take that equity and you go do it again. And that's what refinancing allows you to do. In the market we are in right now, in this environment, I should say, that we're in right now, financing sources are so aggressive, terms are so attractive. It's a bit counterintuitive. I'm not going to even try going down the macroeconomic path because I can't. I don't understand it. But right now, loans are being made for significant dollar amounts at very attractive rates. And in this environment, it makes real estate investment all that much more attractive. The terms become extremely important in a refinance process because it isn't just about the interest rate you get, Trish, or the fee you're paying up front, right? I don't mean to pick on you. You just asked a very good question. How long do I get to hold that loan for? Are there any guarantees that reside in that loan? Do I have to hold back a bunch of money in the first year because the lender wants to see how it performs? Do I have restrictive, what's called covenants, debt coverage ratios, things that the property needs to be able to produce in the way of cash flow for me to be in compliance with my loan? There are so many factors that go into a refinancing package. That is where a great commercial broker is so critical to your success because they're going to look through that term sheet and those loan terms, and they're going to pull out things and then go, hey, hey, Christina, this loan has a covenant in it that is really going to create an issue for you down the road. I don't think we should go with this financing. Very important concept, something we can talk about offline. Chris has done a great job of talking about what he does. He's way less interesting to hear from than I am, so I tried to maximize the amount of time I spoke. And I also love hearing myself talk, which works great. But I would like to turn it over to Chris. I will say Chris has done two loans. He's working on a third for us. He refinanced the building here at 357 Chicago with a extremely unique structure that actually went through a life insurance company. He did the building in Elkhart, Indiana, and then he is working on the Windy City portfolio loan. Chris has introduced me to things in the financing process that I didn't know. I've learned more over the last 2 weeks with this Windy City project than I've learned in 2 years of financing. So I'll stop there. Chris, I think he's really here to answer any questions. So I would encourage anyone to speak up, ask him about his experience or anything you want to hear about with what we spoke about in the presentation.
I must have answered everything, huh?
We had one question that was somebody in the chat had asked about construction loans and the decision process of whether or not to use one.
Yeah, I mean, in my world, that one's usually a pretty easy one. It's just, do you have enough cash to construct the building without a loan? If the answer is no, then you're kind of forced to do it, right? I would just kind of tying back into Eric's point, if you are going to use a construction loan, just make sure that the information, your operating pro forma is realistic and your costs estimates are realistic to your construction lender, and then, you know, try to get through it as quickly as you can, and then you get rid of your construction loan with either a bridge loan or straight to perm, and hopefully shed that recourse. So, you know, most of my clients, when they're constructing something, if they have a lot of money, use like a 30% or 50% loan to cost construction loan. And that way you're using someone else's money, which allows you to stay liquid, but you're still, it's good for the lender. You can get really good terms because at that leverage level, there's not as much risk. But a lot of the construction loans I work on are, you know, 75, 80, or 90%, right? Where it's someone who doesn't have a lot of money, but they have a compelling project. And that's when I go out and I find a lender and I say, hey, here's this guy. He doesn't have the deepest balance sheet, but he's got, you know, an awesome piece of dirt and he's going to build this property and it makes a ton of sense. So hopefully that answers your question.
I have a question about refinancing.
Mm-hmm.
I've seen a lot of headlines out there right now saying that cost of refinancing is going to be a lot higher. I don't know if that's necessarily for under 4 units or over 4 units in the next year. Have you seen this? I believe it's legislation passed.
That's actually under 4. It's I think the nomenclature is adverse market refinance fee. And so basically, Fannie Mae and Freddie Mac, so this is residential mortgages, but in order to keep it liquid, there are no prepayment penalties. So basically what happens when rates drop to historic lows is everyone races to refinance their home, right? So right now, all these bondholders that, and if I'm getting too technical, so Fannie Mae and Freddie Mac packages those mortgages into bonds and sells them off. But so all those bondholders right now have interest rates 4, 5, 6%, whatever the underlying mortgages were yielding, and that money is being repaid to the bondholders, right? Because these lenders are now refinancing out their old debt at 2 and 3%, and it does a couple things. It creates huge volumes and bottlenecks at the mortgage originators and processors, just because everybody and their brothers are refinancing right now. So I think that fee is, the FHFA's introduced that to kind of slow down the volume a bit. But again, at the end of the day, a lot of this job is just arithmetic. So you just need to do the math of, does it make sense to pay that? I think it's an eighth, so 12.5 basis points fee to get out of your old mortgage and get into a new one. I don't think that if you're buying a property, that fee doesn't apply, because it's, if you're repaying, it's only on refinances. So.
All right. Where are we at? Did it. I got it. I have to do my cheesy slide. This one always makes me laugh. For those of you who weren't on the underwriting presentation I did at the very beginning, I have to tell this story because it just shows how much of an idiot I am. I was sitting at a Starbucks right by the old office at 2636 Lincoln. It was Racine and Wrightwood Starbucks. And I don't know who I was talking to, but I was just waxing poetic about real estate investing and how important it is to get into it as early as possible. And I said to this person, I said, I kind of look at real estate investing like an old Chinese proverb. And it's the best time to plant a tree was 20 years ago, and the second best time is now. And I'm just ripping. I'm thinking I am God's gift. And one of my wife's best friends in the whole world, who is an absolute bee buster, looks up, walks over to me, whispers in my ear. She goes, "Are you kidding me? I just heard what you said." And so for the rest of time, I'm going to put this slide at the end of these presentations. And Jen, you should probably edit the end of this presentation to remove everything I just said. But I did that, and unfortunately, I'm not even embarrassed by it. So I'm going to go with it. Seriously, on a serious note, invest. Don't be afraid to jump in and invest in real estate. Use the resources that you have at this company, outside of this company, make the relationships, but don't be afraid to jump in. We're in a very interesting time right now where the unfortunate nature of the pandemic is going to open up real estate investment opportunities. And we're positioning ourselves personally to take advantage of that. We recommend, if any of you are really seriously considering it, now is the time.
And that was beautiful. Way to end it.
Thank you, everybody.
Thanks, everybody.
Thank you.
Thank you, Chris. Appreciate your
Thanks,
time, buddy.
Chris.
Thank you.
Thank you.